So today's Cardinal Lesson, we're talking about the income tax. And we're talking about, if this is you, if you've paid a federal rate of like 12% or 22% or 24%, and you've really filed your taxes and your effective rate is down in the teens somewhere, and you're thinking, this is pretty good. I've done some really good tax planning. And the question I want to ask is, did you leave some money on the table? Because when you get near retirement, the income number that you're going to show to Uncle Sam when you file your tax return, if you have an IRA account or a 401k with a bunch of pre-tax money in it, is your choice. You're able to pick your place along this thing, possibly through our help and using Roth conversion. So I want to bring Tom on, and I want Tom to share with you like why we're doing this video today.
Yeah, we're doing this video because most tax planning we see is very short-sighted, right? You're only focused on this individual year, wanting to pay the least amount of taxes this year, and it misses the big picture, right? You're leaving money on the table, and you're going to wake up one day and realize, man, now I owe all these taxes, and this really hits when RMDs start. So we really just want to walk you through the tax planning and taking a look at the whole picture and looking at the lifetime taxes. How do we pay the least amount of lifetime taxes, not any given individual year? And so let me bring up the show notes here. You can find these at the link below our video. They're also on our website at cardinalguide.com. We have the board, and then these charts, they're just the numbers represented on the board here. I have these printed off right at my desk every day because I use them all the time in our practice. But again, these have a lot of really good information, the key tax brackets that you want to pay attention to. And then the next one is on the IRMA cost, this increased cost for Medicare. So we'll get into that as we go through the show. But again, these documents, I mean, I can tell you I use them every day. I have them right on my desk. So
Okay, so we're going to start out today going over the tax brackets. So if you're looking at the married filing joint and you get a couple that's at $150,000 a year of joint income, they're paying $2,300 a tax on the first $23,000. On the amount from 23 to 96, they're paying $11,000 a tax, and then they're going to pay some more tax up to $150,000. But their effective tax rate is going to be somewhere between 11 and 17, probably closer to about 15, which is generally lower than a lot of people think it, they kind of expected it is if they haven't ever dug into the numbers. They just kind of go through the year. And when you're working, then you earn $150,000 a year between the two of you, or maybe just one of you's working, and then maybe you earn $130,000, and then you got $20,000 of investment income or some other income. Regardless, you don't really view yourself as being in control of that. It's like whatever came in during the year and whatever tax was withheld, and then we're going to file it in April. And whatever we got to do, we're either going to pay money or get money back. And it's sort of a after the fact deal. And what we do in our practice is we do tax planning. So we're going to look ahead, and we're going to look at the next several years and think about how can I lower my taxes? How can I, over a long period of time? And one of the biggest ways you can do that is with Roth conversion. If we go over to a single person and we take a single person at $100,000 a year, they're going to be, again, paying $1,192 or $1,100 on their first $11,000, and then the amount to $48,000 from 11 is $5,500, and then on the amount up to $100,000, another 17, and their effective tax rate is going to be right at about 17%. And so, they're thinking, okay, well, that's what it is. What can I do about it? Well, if you have a large IRA or 401k, if you have a bunch of money that you haven't paid taxes on that you're planning to use in your retirement, maybe you're not even retired yet, or maybe you're already retired and you're living off of maybe some of this money in the big pre-tax deal. That's what's creating the income that you're paying the taxes on. And what I want to point out to you is you can do some Roth conversions, and you can do them in a series over several years to effectively raise your tax bill, which a lot of people come to us, they say, I came to you to lower my tax bill, and now you're in here raising my tax bill. Well, we're trying to be less short-sighted and more future-oriented. And this isn't for everybody, but we want to bring this onto the table for a lot of you to see if we can take care of some of those taxes now through Roth conversions, really taking advantage of these tax rates. The effective tax rates are as low as I've been seeing them in my almost 50 years of practicing in this business. I've never seen tax rates. I mean, I used to work on 40, 50% effective tax rates or marginal tax rates back in the day. And we may see those high tax rates again in the future, given all the deficits that we have. So we really want to just dig down and look at the tax rates we're dealing with right now. And they're set to expire at the end of this year, 2025. But I think there's a good chance that these things are going to be extended through some stuff they're going to pass. But regardless, this is what we got to deal with for 2025. And so even if we look at this just as a one-year thing, is if I was going to do a Roth conversion, how much should I do? And we're going to really use these charts to do that. So I want to bring Tom on, and I want Tom to just give us an example of what we're talking about and how the Medicare tax could come in and affect someone.
Yeah, so I'm going to run through, I'll do an example for a married couple and then one for a single tax filer, just to give you an idea of how we approach this. This isn't a one size fits all solution, right? This isn't necessarily meaning this is exactly what I would recommend you do. It really depends on everyone's situation, but I'll walk you through sort of how we think about it and some of the things we're looking at. And so typically what we see a lot of times is people come in, they've saved well. A lot of their wealth is in traditional IRAs, traditional 401ks, money that has not been taxed yet. And then we start projecting that to the future. We start looking to see when they get to RMD age, whether that's 73 or 75, depending on their age, what kind of projected RMD are they going to have? And what is that going to do to their taxable income, right? Is it going to push them up into these higher tax brackets? Because fundamentally, all tax planning really is trying to pay taxes at the lowest rate possible. Like that is really what we're trying to do here. And what I see all too often is people come in, they've heard about IRMA. Again, that's that increased cost for Medicare. They want to avoid that. They maybe are taking some out of their IRAs to live off of or do Roth conversions, but up to the point that they don't want to pay that extra cost for Medicare, which again, a lot of times that might be the most efficient way to do it. But if you have a large balance in your IRA or 401k, and those RMDs alone might push you above the IRMA thresholds when we look to the future. And so that's, again, when I mentioned short-sighted, a lot of times people aren't looking out that far, right? They're not focused on that. Not to mention, if you're a married couple, what happens when the first tax filer dies or one of the first one to die passes? The surviving spouse is left filing taxes at the single rate. Again, effectively, you're doubling their taxes, right? Immediately. So let me walk you through an example. For this example, we're going to sort of target the 24% rate. Again, just sort of by definition, that means they have quite a bit in their IRA or 401k. But if we start looking at these charts here, we'll do the married couple first. The 24% bracket, at the top of it is $394,000. So you can earn up to $394,000 and stay within that 24% tax bracket. That's a lot of money and still at very reasonable tax rates. And so what we want to do is overlay that on top of the IRMA chart. So if we go down on the board, the box below, we'll look at the married couple. The IRMA bracket they would be in stops around 400,000, right? That's where that top number is. And again, this IRMA only applies to 1 year, but it's 2 years later. So if you do this Roth conversion in 2025, it will affect your 2027 IRMA bracket. We have other videos where we discuss how that works. So if you're interested or you don't understand that, go watch those videos. But it's increasing your Medicare cost for that 1 year, which isn't fun. I will warn you, not a lot of people like doing it, but a lot of times it can make sense to do that for a series of years to lower the balance of their IRA. So then future RMDs don't cause a problem. So in this example, they convert Roth money up to the 394,000 of total income. They're staying within that 24% tax bracket. We're adding an additional $4,235 per person for Medicare in the future. Sometimes, depending on ages of spouse, maybe only one of them is on Medicare by that point. That actually is helpful. But if both are on Medicare, you have to pay that per person. But again, it's a cost we need to account for. But we don't want to only focus on the IRMA brackets, because that's what a lot of people do on their own. Is they learn about this IRMA, they say, I don't want to pay that, so I'm only going to convert money up to a certain point, right around the 22% tax bracket. If you look at the numbers. And again, they just might be leaving money on the table. So let me run through a similar example where we'll use a single tax filer here. Same parameters, same 24% tax bracket. For a single tax filer, that's $197,000 a year. If we look at the IRMA brackets, again, that's the same IRMA level. That one stops around $200,000. Side note, I mentioned that the IRMA affects the IRMA brackets. The income this year affects IRMA 2 years down the road. We don't know yet what the 2027 IRMA numbers look like, right? The ones we have on the chart are what they are currently in 2025. Sort of by definition, there's some buffer built in there, right? Because they typically do increase each year. But again, we don't know what it is. But it likely will be a little bit higher than what we have on the board here. But again, they convert up to the 197,000, filling up the 24% tax bracket. That puts them at that same IRMA threshold for a single tax filer. Again, since it's only one person, it's one person paying $4,235 extra. That's an annual cost extra for Medicare for that person. So again, this isn't a recommendation. It's very specific, very dependent upon your specific situation, how much you have, what your other income is, what your goals are. But that is a pretty typical client that we might look at. If you have less in your IRA, you might not need to go to the 24%, right? Maybe we can stick around the 22%. And if we're looking at those rates, maybe we can do it to an extent where we don't have to pay the IRMA. Or if you have even less, maybe we're just sticking at the 12%, right? It really just depends on you. So if you have questions, you want us to run some analysis, reach out, and we're happy to do so.
Okay, so let's talk about some of the reasons to do a Roth conversion. Tom just went through the Roth conversion versus IRMA, and we don't work in a fixed world. So when you start running your income up to pay a low tax rate, you're going to cause IRMA 2 years later. And understand that IRMA is just going to be for 1 year. And then what we do in 2026 is going to affect 2028. And if you're still working and thinking about retiring, and that's why you're watching these videos and you're coming, you may want to think about doing some of these Roth conversions while you're still working. And then when you retire and go on Medicare, then we're going to file an IRMA appeal and perhaps get this reduced or to go away. So we're going to do this Roth converting before you actually retire. And maybe your spouse hasn't retired yet. And we can do an IRMA appeal based upon your spouse and you. So there's a whole, we have other videos on IRMA, but for Roth conversions, this is the first topic that comes up is IRMA. Okay. The next thing is we're going to spread these over several years, because you don't want to take a big IRA and just convert the whole thing and push yourself into the 37% bracket. We don't want to do that. So we're going to spread them and space them out over several years. No Roth conversion of RMDs. So once you get to 73 or 75, whatever your RMD age, and our software will predict what your RMD is going to be when you come in and do a financial plan with us. And if you don't do Roth conversions, and if we put together a plan of Roth conversions, that's going to obviously lower the RMD, or maybe make it go away if you end up doing all of it by 73, or make half of it go away. So just understand that when you get to RMDs, you have to take that money and pay the taxes on it. It's now out of the IRA. No Roth conversion of inherited IRAs. So a lot of inheritors find out, boy, can I convert this to a Roth? No. You're the beneficiary. We can do some things for you to space out the taxes and space out the distributions. Probably the 10 years rule is going to apply. And they can't do a Roth conversion to have tax-free income. If it's already converted to a Roth, they can inherit it as a Roth and they won't have to pay taxes on it. So understand that. You can't do it on inherited IRAs. The future growth is tax-free. So you do this in your 60s, and then we just let that Roth money sit there and grow. All that growth is ultimately going to be tax-free for either you, your spouse, or your heirs after that. But there's not going to be any more taxes paid or taxes paid ever on the growth once the thing's in the Roth. And then the Roths have no tax on distribution. So when you think about the widow tax, is when we're dealing with a married couple, one of the two of you is going to be a single taxpayer after the first one dies. And these paying taxes on RMDs, required minimum distributions, at single rates of people that are, a surviving spouse in their 80s is not very pretty. You can mitigate that or make it go away with Roth conversions. So let's finish here with talking about why would you not want to do a Roth? What's the downside to doing a Roth? Number one is you got to pay the taxes now, and they need to be paid in cash, either out of the converted money, which creates more tax, or if you're fortunate enough to have money on the sidelines that you can pay the tax, then you can convert the whole amount, but that's a downside. It increases IRMA, which we talked about earlier. It reduces your net worth. I mean, you just pay taxes on something now that you could wait to pay till later. Your overall number is going to go down. Some people are just not comfortable with that. You're betting on tax rates being more in the future. And I just think with the size of the deficit, and as we're going and we're going to stabilize these tax rates in the bill, or at least that's the plan, that they're going to not lower the taxes, but keep them the same for several more years. It's going to create more deficits. Sooner or later, the only way they're going to be able to pay this deficit is by raising taxes. That's my philosophy, whether you buy into that or not. And what you're doing is you're buying into my philosophy. That's a downside. I mean, I could be wrong. And then the state income taxes you're going to have to pay on this conversion, and they're obviously specific by state. We can help calculate those for you, but not on the video because people live all over the country. So within the scope of this, what we've been talking about today, we want to apply this to financial planning. And we've really not talked about these three, and we've talked about 401k and IRA. We've talked about income and your retirement income planning and investment planning. We've talked about your estate planning, and a lot of the reason for Roth conversions is for your estate, and it's also tax-free income in retirement. And obviously this whole show has been about taxes. So I'd like to bring Tom back on. I'm Hans Scheil.
And I'm Tom Griffith.
And we thank you very much for listening.
Thank you.